Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 150. And in this episode, we're reviewing the performance of the global markets during the 10th week of 2025, and that is from Monday the 3rd to Friday the 7th of March. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off in the United States. And being the first Friday of the month, it's time for non-farm payrolls. The growth in new jobs created in the month of February came out weaker than expected, despite President Trump's efforts to slash the federal workforce. According to the Bureau of Labor Statistics, non-farm payrolls increased by a seasonally adjusted 151,000 new jobs in February, which was better than the downwardly revised number of 125,000 jobs in January, but was less than the consensus forecast for 170,000 new jobs. Nevertheless, the unemployment rate ticked up higher to 4.1%. This employment report comes on the back of efforts by the Department of Government Efficiency, better known as DOGE, to scale down the size of the U.S. federal government. Most of the DOGE-related layoffs took place after the February reporting period, which means they will be included in next month's report. However, the latest data from an outplacement firm involved in this exercise indicates that more than 62,000 federal workers have so far been laid off. Staying in the United States, the Federal Reserve Chairman Jerome Powell said on Friday that the U.S. Central Bank will wait to see how President Trump's aggressive policy actions play out in the market before making the next move on interest rates. In a speech for the U.S. Monetary Policy Forum, the Fed chairman said that the White House was in the process of implementing significant policy changes in 4 distinct areas, that is, trade, immigration, fiscal policy, and regulation. The chairman added that the net effect of these policy changes is what will matter for the economy and determine the future path of monetary policy. In related news, on Friday, the U.S. Treasury Secretary Scott Bessent acknowledged that there were signs of weakness in the U.S. economy. He said that the markets and the U.S. economy had become addicted to government spending, and as the country moves away from public spending to private spending, there was going to be a detox period during which the economy was beginning to slow down. Over to the Eurozone. According to flash data that was released on Monday by Eurostat, Inflation in the Eurozone eased off to 2.4% in the month of February, but still came in slightly above analyst expectations, who had expected inflation to dip to 2.3% in February, down from a reading of 2.5% in January. The so-called core inflation, which strips out volatile food and energy prices, this hit a rate of 2.6% in February. The closely watched services inflation reading, which has proven sticky over recent months, also eased off in February as it came out at 3.7%, which was down from 3.9% in January. Staying in the Eurozone, on Thursday, in a move that was widely anticipated by the markets, the European Central Bank cut its policy rate by 25 basis points and updated its messaging to say that monetary policy was becoming meaningfully less restrictive. This rate cut brings the central bank's deposit facility rate down to 2.5%. After the policy meeting, the European Central Bank President Christine Lagarde said that monetary policy was becoming meaningfully less restrictive as lower interest rates was making new borrowing less expensive, and as a consequence, loan growth was picking up. And over to the second largest economy, where a private sector survey released on Monday showed that China's factory activity expanded at its fastest pace in the past 3 months to a reading of 50.8 in February, as millions of migrant workers returned to work after an extended Lunar New Year holiday. The Global Manufacturing Purchasing Managers Index for China came out at 50.8 in February, which was an increase from 50.1 in January. For your information, with regards to the Purchasing Managers Index, a reading above 50 indicates an expansion and below 50 indicates a contraction. This positive economic data comes on the back of an additional 10% tariff from the United States that could put further pressure on China's manufacturing activity, which is a key pillar for economic growth as it accounts for about 25% of China's gross domestic product. On Wall Street this past week, stocks have been on a roller coaster ride this past week as President Trump's tariff policies continue to create uncertainty about the outlook for U.S. growth and inflation. On Friday, investors shook off a weaker than expected jobs report, which raised further concerns about a slowdown in the U.S. economy. Friday's volatile trading session saw the Dow fall more than 400 points at session lows, with the S&P 500 and the Nasdaq also dropping by more than 1% before an afternoon rally turned the tide around. Despite Friday's recovery, the S&P 500 recorded its worst week since September with a loss of 3.1% before coming to a close at 5,770. Meanwhile, the Dow Jones Industrial Average fell 2.4% this past week to settle at 42,801. And the tech-heavy Nasdaq Composite slid by 3.5% during the week to sign off at 18,196. In the Treasury bond market, U.S. Treasury yields advanced on Friday as investors digested the latest nonfarm payrolls report that showed a weaker than expected growth in jobs, which raised concerns about a softening economy. Meanwhile, the latest commentary from the Federal Reserve Chairman Jerome Powell indicates the central bank would adopt a wait-and-see stance in order to determine the impact of President Trump's tariff policy before making the next move on interest rates. In response, the yield on the benchmark 10-year Treasury bond climbed about 2 basis points to 4.30%, whilst the yield on the 2-year Treasury note rose more than 2 basis points to end the week at 3.98%. For your information, bond yields and prices move in opposite directions, and 1 basis point is equal to 0.01%. In the oil market, the price of crude oil was up on Friday, but retreated from session highs after President Trump threatened sanctions against Russia if it fails to reach a ceasefire agreement with Ukraine. Trump said he was strongly considering sanctions against Russian banks as well as tariffs on Russian exports due to its continued attacks in Ukraine. In the meantime, OPEC, which is the Organization of Petroleum Exporting Countries, is expected to proceed with its planned production increase in the month of April, and this is expected to add about 138,000 barrels per day to the market. In response, the global benchmark Brent crude jumped as high as $71.40 before settling back down to $70.50 a barrel. Meanwhile, the U.S. benchmark West Texas Intermediate crude hit a high of $68.22 before correcting to close the week at $67.04 per barrel. In the precious metals market, the price of gold eased off on Friday but was still poised for a weekly gain, mainly due to safe haven inflows and the February jobs report that came out lower than expected and suggests that the Federal Reserve could be on track to cut interest rates later this year. The market is currently pricing in a reduction of 75 basis points to the Fed's policy rate before the end of this year. The US dollar index tumbled to a 4-month low, making bullion, which is priced in dollars, less expensive for foreign buyers. The weaker than expected jobs report, coupled with a weaker US dollar, gave gold a slight boost during the week. Despite being considered a good hedge against inflation, higher interest rates tend to dampen the appeal for this non-yielding asset. In closing, the price of spot gold gained about 1.7% this past week to finally settle at $2,906 per ounce. In the cryptocurrency market, on Thursday, President Trump signed an executive order creating a strategic Bitcoin reserve and marking a major shift in U.S. digital asset policy. Reports from the White House indicate that the reserve will be funded exclusively with Bitcoin seized from criminal cases in order to ensure that taxpayers do not bear any financial burden. Trump's executive order mandates a comprehensive audit of digital assets held by the federal government, which is estimated at about 200,000 bitcoins, and prohibits the sale of Bitcoin from the reserve, positioning it as a permanent store of value. Even after President Trump signed an executive order creating a strategic Bitcoin reserve for the United States, the price of cryptocurrencies fell across the board on Friday, and according to CoinMatrix, the price of Bitcoin fell 2% on Friday and was hovering around $87,000 per coin. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week, the Kenyan shilling held steady versus the US dollar, and according to data obtained from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.23 compared to 129.31 that was recorded the previous week. Meanwhile, the sterling pound was priced at 165.58 and the euro was valued at 138.47. And on the regional front, one Kenya shilling was changing hands for 28.40 Ugandan shillings and 20.24 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.09. The Kenya shilling continues to trade within a narrow range versus the US dollar, and barring any unforeseen circumstances, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves increased by $85 million for a grand total of $9.142 billion, which is equivalent to 4.7 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. Please note that the central bank does not provide any explanation for the change in foreign exchange reserves, and despite my request and several reminders to the central bank, so far there has been no response from them, but I will continue to follow up on this issue and will keep you posted on the progress. In the money markets, the interbank market was sufficiently well funded and was also supported through open market operations, which remained quite active. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The average interbank rate, which is the rate that banks lend to each other on an overnight basis, this was relatively stable at 10.71% compared to 10.75% the previous week. And in terms of volume, the average value that was traded in the interbank market, this decreased to 12 billion shillings, down from 14 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 17.1 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies a percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 6th of March, and the central bank received bids totaling to 50.5 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 210%. However, the central bank ended up accepting only 42.5 billion shillings, and the results of the auction were as follows. The 91-day rate dipped by 1.4 basis points to average out at 8.92%, whilst the 182-day rate declined by about 8.8 basis points to level off at 9.15%, and the 364-day rate was just a shade lower at 10.49%. In the primary bond market, The auction for the monthly Treasury bond was held on Wednesday, the 5th of March. The central bank had offered for sale a reopened 25-year fixed coupon Treasury bond and received bids totaling to 47 billion shillings against an advertised amount of 25 billion shillings, representing a performance rate of about 188%. However, the central bank ended up accepting only 35.2 billion shillings at a weighted average rate of 13.80% compared to the bond's coupon rate at 13.40%. On Kenya's national debt, according to the latest data from the central bank, Kenya's national debt as of December 2024 stood at 10.9 trillion shillings, and this was divided between domestic debt, which stood at 5.86 trillion shillings, and the foreign external debt that is valued at $39.11 billion, which is equivalent to 5.05 trillion shillings. For your information, Kenya's debt ceiling limit was converted into a debt anchor that is now set at 55% of the country's gross domestic product, and given that our current debt to GDP ratio is estimated at about 70%, this means that the government is in breach of its own borrowing target. Up next is our topical issue, and this week we're looking at the growth of collective investment schemes. Despite the sharp decline in domestic interest rates, collective investment schemes, which are also referred to as unit trusts or money market funds, have recorded an impressive 23% growth in assets under management from 316 billion shillings in September to 389 billion shillings in December 2024. For your information, the bulk of these funds in these collective investment schemes is normally invested in short-dated money market instruments such as treasury bills, where interest rates have declined sharply from a peak of 16.29% in January 2024 to the current rate of 8.92%. The Capital Markets Authority has attributed the continued growth in collective investment schemes to the entry of new funds and a heightened interest in money market funds, which are extremely popular with retail investors. As at the 31st of December 2024, the Capital Markets Authority had approved a total of 54 collective investment schemes, out of which only 37 were tagged as active. The growth in assets under management can also be attributed to the entry of Safaricom's ZD Money Market Fund, which received regulatory approvals in November 2024 and in 4 short months has been able to attract over 6 billion shillings in assets under management. The ZD Fund allows customers to invest as little as 100 shillings with a maximum daily limit of 500,000 shillings. To make it even more enticing, the ZD Money Market Fund is available through the ubiquitous M-Pesa wallet and allows customers to make free deposits and withdrawals, essentially empowering Kenyans to take control of their finances and to grow their wealth. Due to its flexibility and convenience, the ZD Money Market Fund is expected to offer stiff competition not only to other money market funds, but also to commercial banks whose interest rate offering on deposits and savings accounts is extremely wanting, to say the least. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please consider supporting this podcast by becoming an active subscriber. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. And for your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamhuri@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, wisdom comes from experience, and experience comes from making mistakes. Think about it. Thank you, and God bless.